Force majeure isn't a theory. It's a legal escape hatch already written into COMEX rules. The $3,500 price point isn't arbitrary. It's where the math breaks and the plumbing freezes. Today, we're looking at the forensic evidence, registered gold drain, paper-to-physical ratios, and the Shanghai premium gap. This isn't about missing profits. It's about whether your claim survives the reset. The problem isn't that the truth is hidden. The problem is that it's scattered across vault reports, exchange rules, and price spreads that nobody connects. So let's start with the place that loves to pretend it's always in control. The COMEX gold market operates on a simple assumption. Most contracts will cash settle, not demand metal. That assumption is the foundation of the entire system. And when that assumption breaks, the system breaks with it. Here's how the casino works. Think of it like theater tickets. 100 people hold claims to the same seat because the theater assumes most ticket holders won't actually show up. As long as that assumption holds, everyone's happy. The theater sells more tickets than it has seats, pockets the revenue, and nobody notices. But the moment everyone decides to show up at once, the illusion collapses. There aren't enough seats. Someone's getting kicked out. Now replace theater tickets with gold. Replace the theater with COMEX warehouses. And replace ticket holders with futures contract owners. That's rehypothecation. Multiple claims to the same physical ounce. The system works beautifully until delivery demand surges. Then the math becomes a problem. Let's break down the mechanics. COMEX gold inventory splits into two categories, eligible and registered. Eligible gold sits in approved warehouses. It meets contract specifications for weight and fineness, but it doesn't have a warrant attached. That means it's not yet committed for delivery. Registered gold, on the other hand, has a warrant. It's ready to go. It can be delivered against a futures contract immediately. Here's the critical distinction. All registered gold is eligible, but not all eligible gold becomes registered. The conversion happens when someone issues a warrant, which can happen in seconds electronically. This flexibility is supposed to prevent delivery stress. If registered stocks drop, eligible can convert instantly. That's the theory. But theory and reality diverge when the ratio compresses. When registered gold drops while open interest climbs, the system enters a danger zone. Open interest measures the total number of outstanding futures contracts. Each contract represents a claim on 100 ounces of gold. So if open interest is high and registered inventory is low, the leverage ratio explodes. We're talking 100 to 1 or higher, 100 paper claims for every physical ounce. The structural flaw is this. The system assumes conversion from eligible to registered will happen smoothly when needed, but that assumption requires willing sellers. If eligible gold owners refuse to warrant their metal for delivery, the registered pool doesn't refill, and if delivery demand continues, the exchange faces a choice: default or declare force majeure. Now, force majeure is the legal mechanism that excuses performance during extraordinary events. In COMEX context, it's the clause that allows the exchange to suspend delivery obligations if physical supply becomes impracticable or impossible. The language is already in the rulebook. It's not a conspiracy, it's a documented procedure. The 2024 UK Supreme Court ruling in RTI versus MUR shipping reinforced strict interpretation of these clauses. The case involved sanctions disrupting payment methods. The lower courts initially ruled that the parties should accept alternative payment as a workaround. But the Supreme Court reversed, stating that force majeure clauses prioritize the exact contract language. If the contract specifies physical delivery, no alternative method is required. The clause simply excuses non-performance. Apply that precedent to COMEX. If the exchange invokes force majeure, they're not obligated to offer alternative settlement methods. They can simply cash settle at the current spot price and walk away. That leaves contract holders with devalued paper while physical premiums explode in the real world. The tell is already visible. When registered gold drops while open interest climbs, the ratio compresses toward crisis. And the data shows this happening right now. Registered stocks have been trending down. Eligible remains static or overstated due to cross-exchange double counting between COMEX and ICE Vault reports. Meanwhile, open interest stays elevated. The rubber band is stretching. Now that you see how the casino operates, let's look at the exact price point where the house can't cover the bets. The $3,500 price point isn't a random number pulled from thin air. It's a structural threshold where the cost of maintaining short positions becomes prohibitive for bullion banks. At that level, the margin requirements and capital reserves needed to hold those positions create a liquidity sinkhole that forces action. Let's start with margin math. Futures contracts require margin, which is the capital you must post to maintain your position. When prices rise, the exchange raises margin requirements to manage risk. This isn't optional. It's automatic. And the higher the price moves, the more capital you need to stay in the game. For bullion banks holding massive short positions, a move to $3,500 triggers a cascade of capital demands. These aren't small retail accounts. These are institutional positions, measured in hundreds of thousands of ounces. Every dollar increase in gold price multiplies across that entire exposure. At $3,500, the notional value of those positions becomes a balance sheet stress test. Banks must choose, post more capital or close the position. But closing isn't simple when you're short physical delivery contracts. You can't just click a button and exit. You need to buy back those contracts or deliver metal. If you buy back, you're bidding against other shorts trying to do the same thing. That's a squeeze. If you deliver, you need physical gold, and if registered stocks are low, you're competing for a shrinking pool. Now, let's add historical context. In 1980, silver hit a peak during the Hunt brothers squeeze. The exchange responded by changing the rules mid-game. They raised margin requirements dramatically and restricted new long positions. The move killed the rally. Prices collapsed. The Hunts were wiped out. The exchange framed it as responsible risk management, but the effect was clear. The system protected itself by changing the playing field. Fast forward to 2025, silver spiked to $91 and the CME immediately raised margin requirements. Not next week, not after careful review, right after the spike. The pattern repeats. When volatility threatens the system defends itself with rule changes. Gold at $3,500 will trigger the same playbook. Here's why that matters. The $3,500 threshold is embedded in bank risk models. These models calculate stress scenarios and capital reserves needed for extreme moves. When gold crosses certain levels, those models flash red. Compliance departments get involved. Risk committees convene. The banks know the exposure becomes untenable, so they act preemptively. The math is straightforward. If even 5% of open interest stands for delivery, registered stocks can't cover it. Let's use real numbers. If open interest sits at 500,000 contracts, that's 50 million ounces of claims. 5% demanding delivery is 2.5 million ounces. But registered gold on COMEX has been trending well below that level. The gap is measurable. Now factor in basis moves and backwardation. Basis is the difference between spot price and futures price. Normally, futures trade at a premium to spot because of storage and financing costs. That's called contango. But when physical gold becomes scarce, spot can trade above futures. That's backwardation. It's a signal that the physical market is tighter than the paper market. When backwardation appears, it means someone is willing to pay more for gold today than for a promise of gold in 3 months. That's not normal, it's a stress signal, and it's been appearing more frequently in recent months, especially in smaller contract sizes and shorter durations. The $3,500 level compounds all these pressures simultaneously. Higher prices increase margin demands. Higher margin demands force position liquidation. Liquidation attempts expose the shortage of registered inventory. Inventory shortage triggers delivery failures. Delivery failures invoke force majeure. It's a mechanical sequence, not a speculative theory. The mechanics explain why it breaks. Now let's examine the evidence that it's already breaking. The vault data tells a story the price chart doesn't. While paper gold trades in tight ranges, physical metal is moving. And it's moving in one direction, out of Western vaults and into Eastern hands. This isn't speculation, it's measurable. The fingerprints are in the warehouse reports. COMEX registered gold has been trending down for months, not dramatically, not in a single panic-inducing drop, but steadily. The kind of drain that shows up when you compare month-over-month data instead of day-to-day noise. Meanwhile, eligible gold remains static or appears inflated due to a reporting quirk nobody talks about, cross-exchange double counting. Here's the issue. The same physical gold can be registered on COMEX and also counted as eligible on ICE. The vault reports don't fully account for this overlap. So when you add up total eligible stocks across both exchanges, the number overstates the actual deliverable supply. The plumbing looks fuller than it really is. Now contrast that with what's happening in the East. Shanghai premiums over COMEX spot have been running consistently above historical norms. When physical gold in Shanghai trades at a premium to COMEX futures, that's a signal. It means buyers in China are willing to pay more for metal they can touch than for a paper claim they can trade. That premium gap reflects physical scarcity in the region with the highest demand. Central bank buying adds another layer. In 2025 and into 2026, central banks removed supply from the floating market permanently. These aren't trades, they're accumulations. The metal goes into vaults and doesn't come back out. It's no longer available for COMEX delivery or London settlement. It's gone from the system. The US Mint data confirms the physical tightness. Premiums on 1-ounce American Eagle gold coins have been running at 3% over spot. Secondary market resale premiums hit 3.45%. These aren't crisis levels, but they're elevated. And they're persistent. Even when paper gold gets dumped during rebalancing events, physical premiums hold. That divergence is the tell. Speaking of rebalancing, let's look at what happened in January 2026. Bloomberg Commodity Index rebalancing forced the liquidation of roughly 2.4 million ounces of paper gold, worth $6 to $7 billion notional. That's a massive sell order hitting the futures market. Paper gold dropped, but physical demand absorbed it without a sustained price collapse. The metal didn't flood into the market. It got bought, and within days, prices recovered. That recovery tells you something. The paper dump was ring-fenced to the futures market. It didn't translate into physical supply. The buyers who absorbed that liquidation weren't flipping it into the physical market. They were closing shorts or rolling positions. The physical market stayed tight. December 2025 delivery data shows another piece of the puzzle. The issues and stops reports, which track who's delivering metal and who's receiving it, show an increase in futures contracts converting to physical distribution. More people are standing for delivery instead of cash settling. That's not normal behavior in a market where 95% of contracts typically close without delivery. The divergence is clear. Paper gold gets sold, physical gold gets bought. The two markets are decoupling in real time, and the longer this continues, the more stress builds in the system. Because eventually, someone holding a paper claim is going to demand metal. And when they do, the exchange will have to choose, deliver or declare force majeure. The drain is measurable. The question is whether the exchange will admit defeat or rewrite the rules. And history suggests they'll rewrite the rules before they admit anything. Force majeure is the system's admission that paper claims exceeded deliverable metal. It's not a conspiracy theory, it's contract law, and the language is already written into COMEX rulebooks, waiting to be invoked the moment physical supply becomes what the exchange calls impracticable or impossible. Let's define what force majeure actually means in this context. It's a clause that excuses performance under a contract when an unforeseen event beyond the party's control makes that performance impossible. In commodity trading, these clauses have been used for natural disasters, strikes, government actions, and broadly defined market disruptions. That last category is the catch-all. It's vague enough to cover almost anything the exchange wants it to cover. The historical precedents are instructive. Force majeure has been invoked for hurricanes disrupting shipping, for labor strikes shutting down ports, for government embargoes cutting off supply chains. But it's also been invoked for less tangible reasons. Market disruptions, systemic stress, conditions that threaten the orderly functioning of the exchange. The language is flexible by design. The 2024 UK Supreme Court ruling we mentioned earlier set a critical precedent for how these clauses get interpreted. The case was RTI versus MUR shipping. Sanctions made it impossible to pay in US dollars as specified in the contract. The buyer offered to pay in euros instead. Seemed reasonable, a practical workaround. The lower courts agreed. They ruled that the contract's language requiring all reasonable endeavors meant accepting alternative payment methods. But the Supreme Court reversed. They ruled that force majeure clauses must be interpreted strictly according to the exact contract language. The contract specified dollars. The clause excused non-performance when payment became impossible. It did not require the parties to accept alternatives. The seller could invoke force majeure, walk away, and face no liability. No compromise, No workaround. Just contract termination. Now apply that logic to COMEX gold delivery. The contract specifies physical delivery of 100-ounce gold bars meeting specific fineness standards. If the exchange declares that physical delivery has become impracticable due to supply constraints, they can invoke force majeure. And under strict interpretation, they're not obligated to offer alternative settlement methods. They can simply cash settle at the current spot price and close the contract. That's the escape hatch. It's legal, it's documented, and it's designed to protect the exchange and its clearing members, not the contract holders expecting metal. Here's where it gets critical. Force majeure clauses distinguish between allocated and unallocated gold. If you own specific bars with serial numbers in a vault under your name, force majeure doesn't apply. Those bars are yours. But if you hold a futures contract or an unallocated account, you have a pooled claim. You don't own specific metal, you own a promise. And promises can be broken under force majeure. The COMEX rulebook language allows suspension of delivery obligations if physical supply becomes impracticable. Not impossible, impracticable. That's a lower bar. It means the exchange doesn't have to prove delivery is literally impossible. They just have to argue it's unreasonably difficult or disruptive to the market's orderly function. That's a judgment call, and the exchange makes that call. The strategic trigger is this. Exchanges invoke force majeure before a visible default occurs. They frame it as responsible risk management. They say they're protecting market integrity. They avoid the headline, COMEX defaults on gold delivery, by preemptively declaring an extraordinary event. The narrative becomes, exchange takes prudent action during market stress, instead of, exchange fails to honor contracts. Why does this matter to you? Because cash settlement at current spot price leaves you holding devalued paper while physical premiums explode. Let's say gold hits $3,500 on COMEX. Physical gold in the real world trades at $3,700 due to scarcity premiums. The exchange invokes force majeure. They cash settle your contract at $3,500. You just lost $200 per ounce compared to what you could have gotten if you'd held physical metal. Multiply that across thousands of ounces, and the wealth transfer is enormous. Understanding the legal mechanism is one thing. Recognizing when it's about to be pulled is another. And the signals are already visible if you know where to look. The signals are visible if you know where to look. Most people stare at the price chart and ask if they're too late. That's the wrong question. The right question is, what is the plumbing telling us about stress in the system? Because the plumbing always breaks before the price reflects it. Start with registered to eligible ratios. This is your primary stress gauge. When registered gold drops sharply while eligible stays flat or rises slightly, that's a warning. It means metal is leaving the deliverable pool faster than it's being replenished. Track this monthly. Compare it to open interest. If open interest climbs while registered falls, the leverage ratio is compressing. That compression is mechanical stress building in the system. Next, watch basis and backwardation. Basis is the spread between spot and futures prices. In normal markets, futures trade at a premium to spot. That's contango. It reflects storage costs and financing. But when spot trades above futures, that's backwardation. It's a signal that physical metal is more valuable than a future promise of metal. Backwardation in gold doesn't happen often. When it does, it means the physical market is tighter than the paper market. It's a stress signal you can't ignore. Then there are margin requirement hikes. The CME playbook is consistent. When volatility spikes, they raise margins. We saw it with silver at $91. Margins went up immediately, not after careful analysis. Not after consultation. Immediately. That's the exchange protecting itself. If you see sudden margin hikes on gold futures, that's not routine risk management. That's the exchange sensing danger. It's a preemptive move to reduce leverage and force weak hands out before the system breaks. Shanghai premiums over COMEX are another critical signal. When physical gold in Shanghai consistently trades at a premium above 2 to 3% over COMEX spot, that indicates Western supply exhaustion. Chinese buyers are paying more for metal they can take delivery of than for paper claims they can trade. That premium gap reflects physical scarcity. And when it widens, it means the divergence between paper and physical is accelerating. Central bank and sovereign fund activity matters too. These buyers don't trade on exchanges. They negotiate off-exchange deals directly with miners or central bank counterparties. When you see reports of large sovereign purchases that bypass futures markets entirely, that's supply leaving the system permanently. It's not coming back, and it tightens the available pool for everyone else. Miner behavior is another tell. Traditionally, miners hedge production by selling futures contracts. But when physical premiums rise, some miners shift strategy. They sell directly into premium physical markets instead of hedging on COMEX. That behavior change signals that miners see more value in the physical market than the paper market. It's a vote of no confidence in futures pricing. Finally, watch the rhetorical shift in financial media. When language around gold intensifies with words like excessive, bubble, dangerous, and overbought, the system is defending itself. The goal is to create doubt, to make you question the move before it matures. That language doesn't appear randomly. It appears when the establishment wants you to stay out or get out. It's psychological defense of the status quo. These signals don't all fire at once. They layer. One appears, then another, then another. The pattern builds, and when multiple signals align, the probability of a forced repricing event increases. The math doesn't have an agenda. The plumbing either holds or it doesn't. Your job is to read the signals before the crowd does. The signals are visible. The mechanics are clear. Now let's address what you actually do with this information. Because understanding the problem without a positioning framework leaves you paralyzed when the system shifts. Allocated physical gold eliminates counterparty risk. When you own specific bars with serial numbers stored in your name, force majeure doesn't touch you. Those bars are yours. The exchange can't cash settle your position because you don't have a position. You have metal. That's the cleanest exposure. No derivatives, no pooled claims, no legal ambiguity about who owns what when stress hits. Avoid unallocated accounts and paper ETFs with redemption clauses that allow cash settlement. Read the fine print. Most gold ETFs reserve the right to settle in cash instead of metal during extraordinary circumstances. That language exists for a reason. It's the same escape hatch we've been discussing. If the fund can't source physical gold, they pay you cash at a price that doesn't reflect the physical premium. You lose the spread. The fund survives. You don't. Miners offer leveraged physical exposure without the delivery risk. When physical premiums explode and paper markets decouple, miners become direct beneficiaries. They're producing the scarce asset. They can sell into premium markets. Their cash flows surge. Their valuations re-rate. And unlike futures contracts, miners don't have force majeure clauses excusing performance. They either produce metal or they don't. That clarity has value during systemic stress. Liquidity strategy matters more than most people realize. Hold enough outside the system to avoid forced selling during volatility. If all your capital is locked in positions that require margin or can be liquidated against your will, you're vulnerable. The goal isn't to be all in at the perfect moment. The goal is to survive the repricing event without being shaken out by mechanical selling pressure. Liquidity gives you staying power. Diversification across jurisdictions reduces single-point failure risk. Vault storage in non-COMEX countries spreads your exposure. If COMEX invokes force majeure, your metal in Switzerland or Singapore isn't affected. If one jurisdiction changes rules, you're not entirely exposed. This isn't paranoia. It's basic risk management when you're positioning for a structural shift in how gold gets priced and settled. The contrarian position is this. If the crowd panics out during a shakeout, treat it as the setup, not the finale. Volatility will spike. Headlines will scream bubble. Commentators will declare the move over, and weak hands will sell. That's the jiggle. That's the mid-move reversal designed to separate you from a winning position. If the underlying stress signals remain intact, the dip is noise. The trend resumes after the emotional selling exhausts itself. Final framing. This isn't about timing the top. It's about surviving the repricing event when paper and physical decouple permanently. The system will defend itself. Rules will change. Narratives will shift. But the math doesn't negotiate. If paper claims exceed deliverable metal and delivery demand surges, something has to give. Either the price adjusts violently upward to destroy demand, or the exchange invokes force majeure to break the contracts. Both outcomes favor those holding physical metal over those holding paper promises. Force majeure is the system's admission that paper claims exceeded deliverable metal. At $3,500, the cost of maintaining the illusion breaks the banks. They'll choose survival over honor. Subscribe to follow the metal, not the hype. Join the WhatsApp channel for daily vault updates and exchange rule changes. Don't let the volatility bully you. Stay liquid, stay disciplined, and I'll see you in the next briefing.